Thank you for coming back to my channel. I'm Ariane. I'm a full-time day trader. I focus mainly on selling option credit spreads and pretty much exclusively on the S&P 500. Most of my option trades are executed using same day expiring contracts. And since the ticker SPX has 3 weekly expiring contracts, that just coincidentally falls in line with a rule known to day traders as the Pattern Daytrader Rule. FINRA rules define a pattern day trader as any customer who executes 4 or more day trades within 5 business days. Under FINRA rules, customers designated pattern day traders by their brokerage firms must have at least $25,000 in their accounts and can only trade in margin accounts. If you happen to trade the same strategy I do, which is selling out of the money vertical spreads, and you only do 1 trade on Monday, 1 trade on Wednesday, 1 trade on Friday, then that's 3 trades and 5 trading days, and you don't violate any PDT rules. Your broker is happy and all is well. Once you become a little bit more experienced in selling spreads and you want to sell multiple vertical spreads in one day, or you want to day trade on Tuesdays or Thursdays, that's pretty hard to do when you're bound by PDT restrictions. So I think you may find this video helpful. A couple of months ago, a member of our private trading forum suggested this method to locking in either a win or a loss without creating a round trip or adding to your day trade count. I don't know if this is a known thing. Maybe people know about this, I don't know, but 99% of us had not heard of it. So I tried it myself, it worked fine, and our members have been using it pretty much daily. We call it the PDT hack, so here goes. All right, friends, here we are on the option chain. Let's say this morning I sold to open a 5-wide vertical spread and I received 50 cents for it. Okay, let's say I went short the 4400, I bought the 4395, I received 50 cents for it. It fills, that's all good. I always go and create the opposite order, and I go ahead and I right away put in my take profit order so that when the price of this spread has decayed to 10 cents, this order fills and I've locked in my $40 net gain. Now, here's the hack. The hack is you don't put in this order. Okay, the hack is instead you put in this order. So you come to the other side of the option chain, you sell a 5-wide vertical spread for the same strikes, except now you're taking the opposite position. I'm going short the 4395, I'm going long the 4400 call, and I am filling it for $4.90. All right, what happens when the market closes? If SPX moves in the direction that you intended it to, and this spread ends out of the money, you receive the max gain, which is $50, the credit that you filled it for. And this, of course, will expire in the money. However, the max loss is only $10, thereby netting you $40 a contract. Now, if the opposite happens and SPX didn't move in your favor, and this spread expired here in the purple, in the money, you would have a max loss of $450 and a max gain on the call side, which would be fully out of the money, and you would keep the entire $4.90, thereby still netting you $40. $4.90 minus $4.50, $40. So there you have it. All right, I didn't even say it when I was screen recording, but both of those orders are opening orders and you do not close them. So you leave them to expire. One will expire in the money, one will expire out of the money. The broker will settle it by the cash value. And so since they're both opening orders, they don't get treated as a round trip. You'll use the hack to lock in a loss. Now, what scenario would that be? I guess if you sold this put credit spread for 50 cents and the market's not moving in your favor and it's going down, and now this price has increased to 70 cents, 90 cents, $1, and now you're getting nervous that, oh my gosh, I'm not going to be able to fill this for $4.90, and now it's going the opposite direction, and now I'm going to risk a max loss on this put credit spread, well, you can still lock in like a 3x loss. So I just use that math as the example here, but you would just sell the call credit spread for $3. And then let's say, your original position worked out, this spread would still expire out of the money and you would receive the max gain. Now this spread would expire in the money and you would have the max loss, except now your max loss would be $1.50. So ideally you wanted it to go to $4.90, but let's just say you got nervous and it was hitting, you still have to have a stop loss rule, right? So you can fill this call credit spread at whatever price. You would just, you would do the math. And yeah, I just wanted to put that example in there as well. If you're wondering what happens if SPX settles in between your strikes, let's use today's settlement as an example. So since SPX settled here, let's pretend that we had sold this spread for 50 cents and that we had sold this side for $4.90. I did the math for you. All right, on the put credit spread side, you would owe $283. Where did I get this number from? Let's see. Your short strike is in the money, and this is where SPX settled. So you would owe the value of your short strike minus where it actually settled, so $333. You would still keep the 50 cents that you made that morning. So 333 minus 50 is 283. And then on the call credit spread side, you would still keep the $4.90 that you received, except that since this strike that you were short the 4440, you would now owe $167 on that strike. And so 490 minus 167 is 323. 323 minus 283 is $40. Okay, so if it ends in between the strikes, all's good. All right, now that I've explained all that, when I first tried the hack and made a video for our members a couple months ago, I accidentally did it a little bit differently. So I made it an iron butterfly, meaning instead of matching up both of the strikes, I went short the same strike on the call side and made an iron butterfly. I'm going to insert a quick 2 or 3 minute video here so you can see my real fill times and prices and see that it actually did work that way as well.
Hey everyone, I thought I would expand a little on the PDT hack that we talked about the other day and utilize it in a real market situation.
This morning, I entered a call credit spread and I went short the 4210 strike somewhere over here. When the price of my call credit spread had decayed to 10 cents, which is the price that I would normally take profit on, instead of closing the spread, I opened the opposite side of the trade so that my first trade would not count as a round trip, right? So let's look at my filled orders. Ignore my iron condor fills. Here is the call credit spread that I opened this morning and I received a 55-cent credit for. And here is the opposite side of the trade. So now I'm going short the 4210 put. Essentially what I have here is an iron butterfly, but don't think about it like that. So I think it's easiest to think about it in this scenario. Assume that I will have a max loss on this put credit spread that I put on. The max loss would be $10. And then assume that I will have the max gain on my initial position, the call credit spread, of $55, thereby netting me $45 per contract, right? If the market happens to reverse and something crazy happens and the opposite scenario is true, you can assume that I will get the max gain on the put credit spread and the max loss on the call credit spread, thereby still netting me the $45. Because if we look at my position on the option chain, there's no way that both of these can win, right? So I think it's easiest to look at it this way. Now that I've done that, I'm not subject to PDT, but I was just thinking, in what real life situation would I do this? Because when I put on this
put credit spread at 490, my short strike was already 40 plus points away from the at the money. So if I come here, I mean, am I really going to put on the other side of this trade when my short strike is here? Like, what is the likelihood of the market in the next few hours running all the way up here to test my short strike? I guess my thoughts is that I wouldn't use this to lock in profits. What I would use this for is if this happened to get tested, and let's say the market did come up here and I wanted to avoid a max loss, then I would use the other side. Then I would put on a put credit spread and look to, get out at 3x.
So I think the bottom line is either spread on the other side will work so long as you get the fill price right. However, if SPX settles in between the strikes, I think that the iron butterfly comes out a little bit ahead. I don't want to overcomplicate this video. I don't want to overcomplicate this, but I don't know. These videos, they live on the internet forever, and I just thought it was worth mentioning, especially if you're going to be like using this on a regular basis. SPX settling in between the strikes is probably rare, but I just wanted to do the math anyways, so I did the math for you. Here it is.
All right, here's the same sticky note math from earlier. Now, let's do the scenario where instead of doing 4440 call, 4445 call, that I went short the 4445 vertical spread, and I bought the 4450 for 490. Here's what the math would look like. All right. The put credit spread side remains the same. I still owe $283, but the call credit spread side, look at the call credit spread side. Both of these strikes are worthless, and therefore I don't owe any money for the strike being in the money. And I keep the entire 490, and there's the math. I come out ahead. Now, the difference is that if I were to put on this hack spread, I would actually get my buying power back. So I would be restored as far as my capital. But if I do it this way and I put on this spread, it requires additional buying power. So there's that to consider.
All right, friends, there you have it. Few key things I want to mention. You can only use this hack on cash settled tickers because one of the options is expiring in the money and you don't want to be assigned shares. Also, I wanted to mention, I don't use this hack on a regular basis because I'm not subject to PDT, but I've been watching my members use this for many months without issue. But I wanted to just mention maybe a nuance that I didn't mention earlier is that, first of all, the order in my example on the call side for 490 is not going to fill until the other side is worth 10 cents. And even then, it's good, don't expect an immediate fill. I don't want you to be under the impression that as soon as the put side has decayed to 10 cents, as soon as the mark reaches 10 cents, that your 490 order is going to fill right away. So you got to have some patience because think about it. You're selling a deep in the money call, and I don't really think that there's going to be buyers lined up to buy that call. So have some patience and don't expect it to fill right away. The other thing is I've even seen members using this hack on further dated options contracts. So if you want to day trade a 1 DTE or a 3 DTE, you can do that as well. But even though your buying power won't be tied up once you put on the other side, the strikes will be. So don't use the strikes again until those contracts have expired and they're removed from your position screen. All right. I hope that this helps someone out there. I feel like that was a crap ton of math and I probably did something wrong. I hope not, but I have seen so many small account traders use this hack on a daily basis and really be able to expand their trading, and I felt like it was worth sharing. Yeah, if you want to join a community of really smart traders, smarter than me, like the one who made this a great discovery, the link to join is in the description section. Thank you so much for watching. See you guys later. Goodbye.